What makes you wealthy in the markets isn't the brilliance of what you do, it's the discipline of what you refuse to do. Most investors don't run out of money because they picked the wrong asset. They run out of patience. They run out of stillness. And they don't notice it until the account balance teaches them. We live in a world that worships motion. Fast replies equal smart. Busy schedules equal important. Constant updates equal responsible. So people bring that same identity into investing, and the market gives them endless excuses to be useful. Trade more often, check prices more frequently, react to every headline. Optimize portfolios every week. Chase the next thing because everyone else is. Financial news doesn't exist to make you rich. It exists to keep you watching. Analysts publish daily opinions because daily opinions create daily attention. Social media glorifies speed because speed looks like intelligence. Slowly, a dangerous belief becomes your default setting. If I'm not doing something, I'm falling behind. It feels logical. It feels professional. It feels like control. But in markets, constant action is not control. It is often self-harm disguised as productivity. Here's the truth most people never confront until they pay for it. Excessive action is one of the primary causes of investment failure. Not lack of knowledge, not lack of tools, not even lack of good assets, but the inability to stay still after a good decision has been made. I call this skill the art of deliberate inaction. It is not laziness, it is not passivity, and it is not hope. It is conscious non-action, grounded in preparation, reinforced by rules, and protected by psychological discipline. Deliberate inaction in the ability to say, I already made the decision. The plan already accounts for volatility. Noise is not a reason to move. Price is information, not instruction. And then you actually do it. This skill exists because markets don't reward the same things life rewards. In life, speed often wins. In markets, speed often destroys. In life, effort often pays. In markets, effort can become overtrading. In life, constant attention can prevent mistakes. In markets, constant attention can create mistakes. To understand why doing nothing is a genuine edge, you have to see the forces investors underestimate. Compounding isn't a formula, it's a force. Quiet, relentless, exponential. Picture this, you invest $10,000 and average 10% per year. After 1 year, $11,000. After 2 years, $12,100. After 10 years, $25,937. After 20 years, $67,275. After 30 years, $174,494. Now notice the psychological trap. In the first decade, it feels slow. In the second decade, it feels real. In the third decade, it becomes life-changing. Compounding hides its best work until late. That's why most people sabotage it early. And here's the connection to doing nothing. Every unnecessary decision interrupts compounding. Not always mathematically, but behaviorally. Because what usually follows unnecessary action, selling when fear peaks, buying when excitement peaks, switching strategies when boredom peaks, taking profit too early, cutting loss too late. Compounding needs 3 things that overactive investors keep breaking: time, staying invested; continuity, not resetting decisions; stability, not turning plans into emotions. Doing nothing is not empty. It's the act of not disturbing the machine that builds wealth. Like planting a tree, you don't dig it up every week to see if it's growing. You water it, protect it, and let time do what time does. Markets are not clean math systems. They are complex ecosystems shaped by economics, politics, interest rates, narratives, liquidity, expectations, randomness, human emotion. Short-term movements are driven by variables you cannot fully see and cannot control. Even institutions with huge capital, elite analysts, advanced models, fast execution, still struggle to consistently beat broad markets in the short run. So when individual investors think they can time tops and bottoms based on a breaking headline, a chart pattern, a hot tweet, a smart money rumor, they're not being ambitious. They're being unrealistic, because by the time the news reaches you, the price has already moved. And even worse, your reaction is rarely neutral. Headlines don't enter your mind as data. They enter as emotion, urgency, fear, excitement, regret, envy. That's why reacting to headlines is usually too late, overconfident, emotionally exaggerated, and strategically inconsistent. One of the most brutal realities in investing is this: you don't need to be right often. You just can't afford to be wrong at the worst possible moments. And the worst possible moments are usually when the crowd is loudest and your emotions are highest. So deliberate inaction becomes a hidden advantage. It prevents you from turning temporary noise into permanent decisions. Most investors think risk equals volatility. No, volatility is just price movement. The real risk is what volatility makes you do. Your brain evolved for survival: immediate danger, clear threats, fast reactions, fight or flight. But investing is a probabilistic system: delayed outcomes, unclear signals, long time horizons, uncertainty as the normal state. So your brain behaves like this. Fear doesn't whisper, it commands. It says, get out before it gets worse. Protect yourself. Stop the pain. So people sell near bottoms, not because they're stupid, because fear is persuasive when the screen is red. Greed doesn't look like greed. It looks like opportunity. It says, this time is different. Everyone's making money except you. If you wait, you'll miss it. So people buy near tops, not because they lack intelligence, but because excitement hijacks judgment. Biases, silent killers. Overconfidence leads to trading too much. Loss aversion causes holding losers too long, selling winners too fast. Confirmation bias is only reading what supports your position. Recency bias means assuming the last 3 months define the future. Herd behavior is doing what everyone does right before it breaks. In that context, doing nothing becomes a kind of mental armor. Not, I don't care, but I refuse to let my nervous system manage my portfolio. People think frequent action is free. It isn't. Visible costs include transaction fees, spreads, and slippage. You rarely get the perfect price. Tax friction. More frequent gains mean you pay taxes sooner, reducing your compounding base. Opportunity cost. Time spent obsessing is time not spent building skills, income, and stability. The things that actually strengthen your investing life. Mental cost. Constant monitoring creates stress, anxiety, impulse decisions, sleep disruption, emotional exhaustion. And here's the quiet tragedy. Even when people win with overactivity, they don't feel peace. They feel relief. Relief is not the emotion of mastery. It's the emotion of someone who is close to self-destruction. Deliberate inaction frees 2 forms of capital: financial capital and mental capital. And mental capital is what keeps you alive through long cycles. Redefining doing nothing. Preparation before stillness. Doing nothing does not mean neglect. It means you did the hard work before the money went in. You don't be still as a personality trait. You earn stillness through structure. Define clear goals and horizon. If your horizon is 10 to 20 years, today's noise is not a signal, it's weather. Without a horizon, every fluctuation becomes a crisis. 2. Know your real risk tolerance. Most people overestimate their tolerance in calm markets. Then volatility arrives and reveals the truth. Your true risk tolerance is not what you say. It's what you can endure without breaking your plan. 3. Understand what you own. You can't hold through discomfort if you don't understand the asset. Confidence is built before the storm, not during it. Diversify intelligently. Diversification is not owning many things. It's reducing single-point failure. If one position can ruin your life, you will never be calm. And if you can never be calm, you will never compound. Write a plan that survives emotions. A written plan is not paperwork. It is a psychological anchor. It answers future use panic with present use clarity. The discipline of deliberate inaction. This is where investors fail. Not because they didn't know the principles, but because they couldn't live them. Here are the rules that separate amateurs from veterans. Rule 1. Ignore noise intentionally. News is designed to provoke. If it doesn't change fundamentals, it doesn't deserve action. Rule 2. Volatility is not a command. Price falling is not automatically a reason to sell. Price rising is not automatically a reason to buy. Rule 3. Rebalancing is maintenance, not trading. Rebalance on a schedule, not on emotion. Maintenance keeps the machine healthy without turning it into a casino. Rule 4. Act only on fundamental change. Act when the reason you invested is no longer true, not when the mood of the crowd changes. The veteran's mindset is simple. I don't move because I feel. I move because reality changed. Doing nothing is hard because it feels like vulnerability. Your brain equates action with safety, but markets punish that instinct. Stillness requires rewiring. Patience as a trained muscle, boredom as a tolerated state, imperfection as a permanent feature, humility as a survival skill, process over prediction. Most people say they want wealth, but what they really want is certainty. Markets don't sell certainty, they sell probability, and probability rewards those who can stay calm inside uncertainty. Remember a moment you sold too early, or bought because you felt rushed, or changed strategy because you were bored. Now imagine the alternative. One decision, then silence, then time. Most people believe investing success requires more activity, more intelligence, more constant engagement. But the market is not a classroom, and it is not fair in the way your ego wants it to be. Markets do not reward the busiest. They do not reward the smartest. They reward the most disciplined over the longest time. The real battle is not against volatility. It's against your fear, greed, impatience, need to feel in control. When you master deliberate inaction, investing stops feeling like a frantic race and becomes what it always was, a long journey where those who can stand still, quietly, win. Choose what you won't do. Think carefully about this, then decide, today, what you will not do next.